What if I told you that the most profitable move this luxury hotel made wasn't a new casino, wasn't a celebrity event, wasn't even a booming tourism season, but quietly removing gold bricks from a hotel lobby? Real gold. 79 kilograms of it, once placed only to impress the eye. When the business was bleeding losses, when casinos were shutting down, when the market was shaking, this one silent decision flipped everything. Was this genius timing, or a warning signal about what's really coming in the global economy and who's prepared for it? Stay with me, because this story isn't about a hotel. It's about why smart money moves before panic starts. Welcome back to Market Metal, a channel where we don't chase noise. We read the signals beneath it. If you're watching this, and you've seen a few economic cycles in your life, like a wise friend over 50 who's learned patience beats hype, then gently, thoughtfully, subscribe. Not for excitement, but for calm clarity when markets get loud. And before we begin, tell me in the comments, where in the world are you watching from today? The signal most people misread. When gold prices rise to record levels, most people assume the story is simple. They believe high prices mean fear. They believe selling means loss of confidence. And they believe that if someone is selling gold, something must be wrong. That assumption is understandable. It is also often incorrect. In periods of economic uncertainty, gold attracts attention because it does not depend on promises. It is not a bond that requires repayment. It is not a stock that depends on growth. It is not a currency that can be created overnight. For centuries, gold has functioned as a reserve of last resort. When trust weakens elsewhere, gold becomes a place to stand. But this same logic leads many observers to a dangerous misunderstanding. They assume that when gold holders sell at high prices, it means fear is over, or worse, that the gold trade has failed. In reality, the opposite is often true. Sophisticated holders do not treat gold like a lottery ticket. They treat it like a tool. At record prices, gold stops being just protection. It becomes optionality. It becomes liquidity. And for decision makers under pressure, liquidity matters more than symbolism. This is why the act of selling gold at record prices should not be read emotionally. It should be read strategically. Most retail participants view gold in a single dimension. They buy it because they distrust the system. They hold it because they expect crisis. They sell it only when fear fades or when they need cash. Their decisions are driven by emotion and timing. Institutions do not operate this way. For corporations, sovereign entities, and long-term capital allocators, gold is not a belief. It is a balance sheet asset. It sits alongside property, cash, receivables, and liabilities. It has a role, and that role can change depending on circumstances. When gold prices reach extreme levels, that role expands. At elevated prices, gold becomes one of the most efficient sources of non-dilutive liquidity available. It does not require issuing new shares. It does not increase debt. It does not renegotiate terms with lenders. It can be converted into cash quickly, quietly, and with minimal friction. That conversion is not panic. It is preparation. This distinction is critical. Selling gold is not the same as rejecting gold. Often, it is the final step of gold doing exactly what it was meant to do. To understand this, one must separate the idea of gold as a signal from gold as a solution. Gold prices rise when stress accumulates. That stress can come from inflation, currency debasement, regulatory shifts, geopolitical risk, or structural change. Gold does not create these pressures. It reflects them. By the time gold reaches record levels, the stress has already been present for a long time. What changes at record prices is behavior. At low prices, gold is held quietly. At moderate prices, it is debated. At record prices, it becomes actionable. This is when strategic holders ask different questions. Not, will gold go higher? But, what problem can gold solve right now? That question leads to decisions that confuse the public. A company under restructuring pressure may sell gold to stabilize cash flow. A firm exiting one industry may sell gold to fund transition into another. A group facing regulatory overhaul may sell gold to reduce non-core assets and improve ratios. None of these actions imply that gold has lost its value. They imply that gold has succeeded. The mistake most observers make is assuming that selling is a forecast. In reality, it is often a response. Gold selling at high prices usually follows stress, not confidence. It follows disruption, not calm. And it often appears alongside broader shifts that are invisible in headlines. This is why context matters more than price. When analysts focus only on spot prices, they miss the balance sheet story underneath. They miss the fact that gold is often held for years without action, precisely so that it can be mobilized when circumstances demand flexibility. In other words, gold is not always held to be hoarded forever. It is held to be used when it matters most. The difference between panic selling and strategic selling lies in timing, scale, and intent. Panic selling happens into weakness. Strategic selling happens into strength. Panic sellers react to falling prices. Strategic sellers respond to rising ones. This is why record prices are a signal not of the end of gold's relevance, but of its peak utility. Another misconception arises from the belief that gold selling must reflect a bearish outlook on the global economy. In many cases, the opposite is true. Strategic sellers often expect continued volatility, not stability. They sell gold not because they trust the system, but because they anticipate change and need optionality. Liquidity allows adaptation. Optionality allows survival. This dynamic becomes even more important during periods of structural transition. When industries are reshaped, regulations rewritten, or business models disrupted, fixed assets lose flexibility. Gold, by contrast, converts friction into freedom. That freedom is why gold appears on balance sheets in the first place. When observers see headlines about gold being sold at record prices, they often ask the wrong question. They ask whether gold's rally is over. The better question is why the seller needed liquidity at that moment. Was the sale forced or voluntary? Was it defensive or opportunistic? Was gold the core asset or a supporting one? Without answering these questions, price alone explains nothing. History provides repeated examples of this pattern. Gold has often been sold at high prices during moments of stress, restructuring, or policy change. In many cases, those sales were followed by continued strength in gold itself. The sale did not mark the top, it marked a decision point. For long-term observers, this creates a paradox. The same event that alarms casual investors often reassures experienced ones. Strategic selling suggests foresight, not fear. It suggests awareness of constraints, not confidence in stability. This is why serious decision-makers avoid binary interpretations. They do not ask whether selling gold is good or bad. They ask what conditions made the sale rational. At record prices, gold stops being just a hedge. It becomes a lever. Understanding this reframes the entire discussion. The question is no longer, why are they selling gold? The question becomes, what pressures are they preparing for next? Because selling gold is rarely the first move. It is often the last preparatory one. And that is what makes it worth paying attention to. Who sells gold at the top, and why when headlines announce that gold is being sold at record prices, the instinctive reaction is suspicion. People assume weakness. They imagine desperation. They picture someone losing faith in the metal just as it reaches its peak. But the reality is more selective and far more unsettling. Gold at record prices does not invite everyone to sell. It invites only a specific kind of seller. And understanding who those sellers are matters far more than the price itself. The first group is corporations. For most companies, gold is not a speculative asset. It is not held to beat the market. It is held as a reserve, often quietly, sometimes for years, waiting for a moment when its conversion can change outcomes. These corporations do not wake up one morning and decide to trade gold. They act when structural pressure forces a reassessment of priorities. When a business model changes, when a division is shut down, or when regulation reshapes an industry, non-core assets come under scrutiny. Gold, even when valuable, does not generate cash flow. It does not employ people. It does not adapt to new rules. At record prices, it becomes the cleanest asset to mobilize. Selling gold in this context is not retreat. It is reallocation. The second group is institutions. Institutions operate under constraints that are invisible to the public. Capital ratios must be maintained. Risk exposure must be adjusted. Non-productive assets must justify their place on the balance sheet. Gold plays a role in this structure, but that role is conditional. At elevated prices, gold's weight on a balance sheet increases. This can trigger internal thresholds. What once functioned as insurance may suddenly represent excess concentration. Selling a portion allows the institution to rebalance without signaling distress. This behavior often appears counterintuitive. To outside observers, it looks like selling the strongest asset. Internally, it looks like reducing imbalance. Then, there are sovereign-linked entities and groups tied to policy shifts. These sellers operate under a different logic altogether. Their decisions are rarely driven by price alone. They respond to political change, regulatory reform, or strategic realignment. When governments alter rules, close sectors, or force consolidation, assets once considered symbolic lose relevance. In these moments, gold is not abandoned. It is converted. The key distinction here is between forced sellers and voluntary sellers. Forced sellers liquidate into weakness. They sell because they must. Voluntary sellers sell into strength. They sell because they can. Record gold prices favor the latter. This is where the public narrative breaks down. Most people assume that selling gold means rejecting gold, but strategic sellers often retain exposure even after selling physical holdings. They may keep indirect exposure, derivatives, or alternative hedges. The sale of physical gold does not necessarily equal a bearish stance. It often reflects a shift in form, not belief. This distinction is subtle, and it is why surface-level analysis fails. Another critical factor is timing. Strategic sellers do not sell because prices are high. They sell because prices are high at the same time that pressure elsewhere demands flexibility. These pressures can include regulatory change, industry shutdowns, debt renegotiation, or structural transition. Gold provides a release valve in these moments. It allows action without dependence on lenders, markets, or public offerings. Selling gold becomes a way to move quietly in a noisy environment. This is why gold selling often coincides with periods of visible disruption. Casinos close, industries consolidate, governments rewrite rules, business models shift. Gold, once decorative or symbolic, becomes redundant. At that moment, its highest value is not aesthetic or ideological, it is financial. This creates an uncomfortable insight. Gold is often sold not because conditions are improving, but because conditions are becoming more complex. The seller does not expect calm, they expect uncertainty. They sell to prepare, not to celebrate. For those watching from the outside, this behavior creates confusion. The price signal says one thing, the action says another, and the gap between the two is where misunderstanding grows. It is also where the warning lies. Because when experienced operators convert gold into liquidity, they are not making a directional bet on the metal. They are making a judgment about optionality. They are deciding that flexibility matters more than static protection. That decision should not be ignored. There is another layer to this dynamic. Selling gold at record prices also sends a message to markets, not of weakness, but of competence. It demonstrates that the seller understands timing, understands cycles, and understands balance sheet mechanics. Markets tend to reward this behavior. Equity prices often respond positively to strategic asset sales, especially when they improve clarity and reduce uncertainty. Investors prefer companies that act decisively rather than those that cling to symbolism. This response further confuses casual observers. They see gold sold and stock prices rise. They assume contradiction. In reality, the market is reacting to discipline. Discipline is what separates strategic sellers from reactive ones. And this is where the deeper suspense begins. Because once gold is sold, the question is no longer about gold. It is about what comes next. What is being funded? What risk is being reduced? What transition is underway? Gold selling is rarely the story. It is the preface. Understanding who sells gold at the top reveals something unsettling. The most informed actors do not wait for clarity. They prepare in advance. They use strength to reposition. They trade symbolism for maneuverability. For decision makers watching these moves, the lesson is not to copy them blindly. It is to recognize the signal embedded in the behavior. When gold is sold into strength by strategic holders, it suggests that the environment ahead will reward those who are flexible, liquid, and ready to adapt. And that raises a more difficult question. If gold is being converted into action, what kind of environment requires that level of readiness? That question cannot be answered by price charts alone, and it leads directly into the broader conditions shaping these decisions, conditions that are still unfolding. That is where the real risk and the real signal begins. What this behavior reveals about the system itself. Gold does not move in isolation. It moves as part of a system under strain. When strategic holders sell gold at record prices, the action reflects more than a balance sheet decision. It reveals something about the environment they believe they are operating in, and that environment is rarely calm. Periods of aggressive gold selling by informed actors tend to align with moments of transition. Not recovery, not collapse. Transition. These are the phases where old structures stop working, but new ones are not yet stable. During such phases, capital behaves differently. Long-term certainty becomes less valuable than short-term flexibility. Assets that are powerful in theory but rigid in practice lose priority. Liquidity becomes the dominant advantage. Gold, in this context, shifts roles. At earlier stages of stress, gold functions as protection. It absorbs distrust. It preserves value while other instruments wobble. But as stress matures and complexity increases, gold begins to serve a different purpose. It becomes a funding source for adaptation. This shift is subtle, and it is why many observers miss it. The broader system sends signals long before outcomes become obvious. Regulatory changes appear. Policy frameworks are rewritten. Entire industries are forced to consolidate or exit. These changes do not happen overnight, and they do not always trigger immediate market panic, but they do force decisions behind closed doors. Gold sales often emerge from these rooms. When rules change, certainty collapses. Forecasts lose reliability. Even profitable operations can become liabilities if their structure no longer fits the new environment. In these moments, holding static assets becomes risky, regardless of their price. The goal shifts from preservation to mobility. This is where gold's unique nature becomes visible. It is one of the few assets that can be converted quickly without asking permission. It does not require market optimism. It does not rely on counterparties behaving well. It can be monetized even when confidence elsewhere fades. That is why gold selling often accelerates during regulatory upheaval, not economic booms. Another systemic factor is volatility itself. High gold prices rarely exist in stable conditions. They are usually accompanied by sharp moves, sudden reversals, and fragile liquidity. This volatility is not noise, it is information. It tells informed actors that the system is sensitive and that margins for error are shrinking. In such environments, optionality becomes priceless. Selling gold provides that optionality. It creates room to maneuver. It allows quick responses to shocks. It buys time. What makes this behavior unsettling is not the act of selling, but the timing. Strategic sellers often act before the full consequences of systemic shifts become visible. By the time the public debates whether gold sales are bullish or bearish, the sellers have already moved on to the next problem. This creates a perception gap. To the public, gold selling appears sudden. To the seller, it is overdue. This gap is a warning sign. It suggests that decisions are being made based on pressures not yet fully reflected in prices. It implies that balance sheet stress exists beneath the surface, even if headline indicators appear stable. Gold's role in these moments is revealing. It becomes less a store of value and more a tool of transformation. This transformation often coincides with structural realignments. Governments tighten oversight. Industries are reorganized. Legacy agreements are terminated. Companies discover that what once gave them prestige now creates friction. Gold, especially when held for symbolic or decorative reasons, becomes expendable. The act of selling it is not emotional. It is practical. There is also a geopolitical layer to this behavior. Global systems are increasingly fragmented. Capital does not move freely in all directions. Supply chains are re-engineered. Strategic assets are reconsidered. In such an environment, holding flexibility inside one's own balance sheet becomes a form of resilience. Gold facilitates that resilience, but only when it is used. This challenges a deeply held belief. Many assume that the ultimate purpose of gold is to be held indefinitely. In reality, its highest value often appears at the moment it is mobilized. That moment is not random. It tends to occur when uncertainty is rising faster than visibility, when policy risk exceeds market risk, when structural change outruns pricing models. In these conditions, gold selling is not a signal that danger has passed. It is a signal that danger has changed form. This distinction matters. Observers who interpret gold selling as a sign of safety may be misreading the situation entirely. The seller is not relaxing. The seller is repositioning. And repositioning implies expectation. Expectation of volatility. Expectation of disruption. Expectation that static defenses will not be sufficient. This is why the behavior deserves attention, because gold selling at record prices does not tell us that trust has returned. It tells us that complexity has increased. It tells us that adaptation is underway. And it tells us that the system is moving into a phase where flexibility will separate survivors from casualties. That realization reframes the entire discussion. The question is no longer whether gold is strong or weak. The question is, what kind of environment requires strategic holders to convert their strongest asset into liquidity? The answer to that question does not lie in gold markets alone. It lies in what decision makers are preparing for, quietly, deliberately, and ahead of consensus. And that brings the analysis to its most important point. What to watch next? What serious decision makers should watch next? By the time gold is sold at record prices by strategic holders, the most important decisions have already been made. The sale itself is rarely the headline risk. It is the quiet preparation that follows it. This is where disciplined observers shift focus. Instead of asking whether gold prices will rise or fall, serious decision makers ask what the seller intends to do with the liquidity. Because liquidity is never neutral. It always has a destination. And that destination reveals expectations about the future. The first signal to watch is redeployment. If proceeds from gold sales are used to stabilize operations, reduce liabilities, or exit vulnerable segments, the message is defensive. It suggests the seller anticipates prolonged pressure and wants to survive it intact. This is not panic. It is damage control ahead of uncertainty. If proceeds are used to reposition into new lines of business, acquire distressed assets, or fund structural transitions, the signal is more complex. It suggests that disruption is not only expected, but exploitable. In this case, gold has functioned as bridge capital between old and new environments. Both outcomes point to the same conclusion. The seller does not expect stability. The second signal is concentration. Is the gold selling isolated, or is it appearing across unrelated entities at the same time? Is it confined to a single sector, or does it cut across industries, regions, and balance sheet profiles? Isolated sales suggest local restructuring. Broad patterns suggest systemic pressure. This distinction matters, and when gold selling spreads beyond one-off cases, it implies that multiple decision makers are responding to similar constraints that may not yet be visible in macro data, but are already shaping internal forecasts. The third signal is behavior after the sale. Do sellers rush to re-enter gold at lower prices, or do they remain liquid? Do they increase hedging elsewhere, or reduce overall exposure? Do they communicate confidence, or remain deliberately vague? Silence is often the most telling response. Strategic actors rarely explain their reasoning in real time. By the time explanations are offered, the window has usually closed. This is why behavior must be read, not statements. Another critical signal lies in price reaction. Markets often respond positively to disciplined asset sales, especially when they simplify narratives and reduce uncertainty. Rising equity prices following gold sales do not indicate optimism about the economy. They indicate relief that management has acted decisively. Relief is not confidence. It is temporary stabilization. This difference is subtle but important. True confidence appears when long-term commitments increase. Relief appears when short-term risks are reduced. Gold selling followed by equity strength often reflects the latter. There's also a timing element that cannot be ignored. Gold selling that occurs near regulatory deadlines, policy shifts, or structural reforms should be read differently than selling driven purely by price. When asset sales align with external change, they signal preparation for new rules, not reactions to old ones. This is where many observers make a fatal error. They assume that selling gold at high prices means the seller believes the crisis is ending. In reality, it often means the seller believes the next phase will require agility. Agility demands cash. Cash demands sacrifice. Gold, even at record prices, is still an asset. And assets can become constraints. The most uncomfortable insight emerges here. Gold selling does not reduce risk. It changes its shape. By converting gold into liquidity, the seller trades protection against one set of outcomes for flexibility across many others. This is not a bet on safety. It is a bet on uncertainty. And uncertainty rewards those who move early. This brings the analysis to its sharpest edge. If strategic holders are selling gold not to retreat, but to reposition, then the environment ahead is unlikely to favor static strategies. Long-term holders who assume that protection alone is sufficient may find themselves ill-prepared for rapid change. This does not mean gold has lost relevance. It means its role is evolving. Gold protects against breakdown. Liquidity protects against transition. The question is not which is superior. The question is which phase the system is entering. That phase cannot be identified by price charts alone. It must be inferred from behavior, timing, and context. Gold selling at record prices, when viewed correctly, is not a conclusion. It is a clue that pressure is shifting, that rules are changing, and that preparation is underway. And that leads to the final unresolved tension. If gold is being converted into flexibility by those closest to structural pressure, then the real risk is not that they sold too early. The real risk is that others may not realize why they sold at all, until the next set of constraints becomes impossible to ignore.